Guys, the stock market bounced recently on the fall of longer term interest rates, but the idea that rates have peaked and so the stock market will continue to go higher just got a cold dose of reality with a very bad 30-year bond auction today. I'm going to look at how bad it was compared to past auctions and what it could mean for long-term bond rates going forward. Let's start off by looking at how our total interest on our debt has now reached $1 trillion a year. So Zero Hedge talks about the interest on U.S. debt skyrocketing above $1 trillion for the first time ever. And so this is the Treasury's own calculations right here. You see it is now above $1 trillion, just the interest on our debt. And it's easy to see how that's possible because according to the Treasury, the average interest rate on the marketable U.S. Treasury debt is about 3%. So marketable debt is treasuries that sell on a secondary market. You can buy it and you can sell it and you can buy it again, whereas you can't do that with the government I bonds and EE bonds. So the 26 trillion in marketable debt is $805 billion in interest, and the non-marketable debt, which is 7.6 trillion, adds another 222 billion in interest, and that's how you get 1.027 trillion just in interest. So if things are so bad, why did the stock market rally and why did the interest rate on long-term bonds go down? Because of this, it was reported that there's about $1.5 trillion in debt going into this quarter and the next quarter that they're going to have to issue. But the stock market rallied because the US Treasury revealed that they had lower than expected rate of debt sales in their quarterly refunding plan. So the Treasury expected to issue $776 billion in debt in the current quarter, which is $76 billion below the previous forecast published last quarter. And so they say this is a welcome slowdown in debt issuance as a result of slightly higher than expected tax receipts in October. So this seems to be the reason why the stock market rallied and long-term bond rates had fallen. That is until today's 30-year auction. So Zero Hedge once again say yields surge after catastrophic 30-year auction stops with biggest tail on record as foreign demand craters. And so they say the 30-year bond priced at a high yield of 4.769, which was slightly below last month's 4.837 and just shy of the April 2010 high. But more importantly, it tailed the when issued by a whopping 5.3 basis points, which was, well, terrible because as shown in the chart below, this was the biggest tail on record going back to 2016. So this is a chart of the 30-year stop through and the tail. Above the zero line is the stop through, below is the tail, and you see the tail has surpassed this tail here. And so this is the lowest tail going back to 2016. Okay, so I know you're thinking, what the hell is a tail and why is it bad? And what is stop through and when issued and all of that? So let's start with the when issued. What when issued is trading of a security before it's actually issued. This can happen with stock splits, stock spin-offs that are announced, or bonds or treasury bonds in this case. And so when the Treasury announced an auction is going to happen, it's not going to happen for a few days still. So when issued is actual trading between people or dealers or whatever, that dealers are saying, hey, I'll sell it for this price, and people are bidding for it at this price. And it's kind of like a price discovery where you can buy this thing before it actually starts trading. And so what that does is kind of give a price discovery and indication of where this thing is going to price and subsequently what the interest rate will be. Think of it a little bit like horse racing, where before the horse race starts, people betting on different horses changes the odds of those bets, right? So the when issued market kind of predicts where the auction will end up at what interest rate. So if the when issued market is trading right up until the point of the auction, and the interest rate that it's trading at, or the price and the equivalent interest rate, let's say that interest rate is 4.6%. That's where the best guess of the buyers and sellers at that time are saying that the rate is going to auction off at. Let's say the auction goes off and it's actually at 4.5% instead of the when issued rate of 4.6%. That's called stop through. That's considered positive because a lower interest rate means people were bidding higher prices for these bonds. So that is bullish or positive for the bonds. Conversely, a tail means that the people were bidding actually less than the when issued market, and so the interest rate was actually higher than the when issued market predicted. And so they're showing here that the 5.3 basis points tail is a big anomaly, and it is very negative for the demand for these 30-year bonds. And that's why the market started to sell off when that happened, and they saw that there's a very weak demand for these 30-year bonds at these interest rates. Now, at higher interest rates, there may be some newer demand coming in. And so some more details here. The bid to cover ratio was just as bad at 2.236. It was the lowest since December 2021. What is the bid to cover ratio? Let's say they're selling $1 billion in bonds. If they have orders for 2.236 billion for those bonds, then the bid to cover ratio would be 2.236. Now, this is a big negative right here, that the foreign bidders, known as the indirects, tumbled from 65.1% to 60.1%, and that's the lowest since November 2021. So if foreigners aren't buying our bonds, or at least at these prices, interest rates are going to have to go higher if there's less demand, or the demand is only at higher rates. Okay, directs were only 15.2%. Banks, the dealers, were forced to step up and take the balance, or a whopping 24.7%, which is double the recent average of 12.7% and the highest since November 2021. Now, this is interesting because they say this is a big warning flag, because every time we have seen a surge in dealer takedowns, some sort of Fed intervention, QE or otherwise, has usually followed, and we doubt this time will be different. So here's a chart of the indirect bidders percentage-wise in red, direct bidders in green, and primary dealers in blue. So you see the primary dealers had to take in a whole bunch of this issue, the most since back here in 2021. And the bid to cover ratio has been as high as over 3 over here. And right now we're at like 2.25. So not as strong demand as usual. And here's a chart of the 30-year bond interest rates, and you see that they dropped after the payrolls data, but now we are almost right back to that level, that high level that they were before that data came out. So that jump in the yield of the 30-year bond is the biggest going back to the pandemic over here in 2020. So the jump in yields on the 30-year bond auction also caused the yields on the 2-year, 5-year, 7-year, 10-year also to jump as well. And as those yields rose, all the market indices, S&P, the Dow, the NASDAQ, and the Russell 2000 all fell. And here is a scary chart. This is U.S. government securities liquidity index. And the higher up it is, the more illiquid it is. And the lower, the more liquid it is. And you see, we are now up to illiquidity levels going back to 2010, around the great financial crisis. So this spike up to this level is even higher than the spike we had during COVID. And so they end by saying the Fed and the Treasury have a problem. So with our government spending trillions of dollars more than they make in taxes and giving out hundreds of billions of dollars to other countries while we foot the bill and pay the interest, I find it hard to believe that long term rates will stop at 5% when we have less and less foreign buyers interested at the current rates. If long term rates go even higher, less people can afford houses, and the higher interest expense companies pay cuts into their profits. That can't be good for home prices or the stock market. Invest accordingly.